Go rent a unit from Extra Space, for example. Even if you don't finish the rental process completely, you'll notice that they will ask you some questions about whether you're a student, how long do you plan to stay, some other things that they can then feed into their system. Where are the middle-aged families that have some disposable income and have some need for storage over a longer period of time, right? They're gonna make a lifestyle choice rather than solve a problem for 3 months like a student choice, right? And definitely where we're moving towards is to understand better and segmenting our customer base and not applying the same rate increase strategies to everyone, right? We're applying different rate increase regimes or strategies to different segments, right? Because some segments are much more likely to stay, some segments are more likely to go, and there's some clues about price sensitivity that you can glean based on kind of the way you operate your business.
Welcome everybody to Self-Storage Income, and Connor and I today have a guest who I met years ago, and I'm really excited to bring him in to talk about, a lot of things, but I'm really excited to talk about management because I know his company. I've seen what they did. They actually put a proposal in for a facility that we had partners on in another state that we weren't running. And we were very, very impressed with him and his company. So I've been really excited about this podcast for a long time.
Yeah, no, thanks a bunch for putting it together, AJ, because I'm really excited to dive in. You've introduced me to a lot of your friends, but this is what I've missed, unfortunately. So I'm really excited to jump in and, all things operations, things are always changing. What we're doing is always changing. The strategies, the competition, all the things are always happening, right? So I always love jumping in and just hearing, what are other people seeing? It's always hard when you feel like you might be on a silo. You only have your own data and information you're working from. And this is what's so important about getting out and connecting with people that are also doing the thing that you're doing so that you can really draw from all those experiences.
And the rate, I don't think it's just the rate of change because that's happening, but also the source of it. Like, it seems like it's coming from everywhere.
Yeah.
So I'm always surprised when we're talking to somebody like, oh, you're doing what? I've never even heard of that company, or, how's that working, or how they see it. So we're excited about that. With that, we are bringing him in. So Kenny, how you doing, man?
I'm doing great. Feeling a little left out. I don't have the big beard, but otherwise doing awesome.
There's got to be a filter or something we can put on for you.
Well, why don't you give us a quick background? You have a background in storage here, so why don't you tell us a little bit about how you got into this industry and how you got to where you are today?
Quick background. Started doing storage back in 2002. I was an employee for the guys I'm currently partners with. Came out of business school as an analyst and started underwriting deals. Back in the day, we were syndicating, so we were charging about somewhere between a 2 and 3% acquisition fee. And so I told, when I was interviewing with these guys, I was like, look, I know I can help you find at least one more deal a year, and that's more than going to pay for my starting out of MBA school salary, back in the day. Yeah, and we just built a portfolio through syndication, ended up merging all those syndicated properties into we called it, at the time, we didn't have a name for it, just a new co. We called it Storage Up REIT Partners, and became LifeStorage. We raised a bunch of private equity and had a huge line with Citigroup, and ended up rolling up 84 locations, sold it off to Sovereign back in 2016, made a bunch of money, and started over again, resyndicating. We my partner's name is Greg, kind of talk about it onto smaller and better things. There's definitely some beauty in not having institutional capital and not having to prepare for board meetings and things like that. So like I was telling AJ earlier before we got started, that today's new boat day for me. So even though I'm dressed up for this podcast, it's actually all going to come off in a few minutes, and we're going to have a board meeting that's just going to be on Lake Coeur d'Alene.
That's right. And that's where it should be.
Yeah.
With the family. Now,
I love it.
What's your portfolio look like today then?
So we've got 43 stores that we manage. We own 25 of them. And I say we own, we're still syndicating deals. So me and my partner, Greg, we're the GPs, and we have limited partners who come in with equity alongside of ours. And we basically do all the due diligence, put together the financing, and operate the properties post-acquisition. And then the other ones we manage for other people as kind of a third-party manager. We have ambitions to grow, but we're very careful about our growth. We want to make sure we're doing it in ways that in areas like parts of the country, we're mostly in the Western U.S., so that's kind of our sweet spot. And, we're really careful to not try to take on clients that we don't think we can hit a home run for. So
we have a facility that is in Nevada, and we were trying to put in some new technology into it and how we were doing stuff. And it was kind of a crazy thing. But because of how we were doing it, we went a certain direction. But you were the choice. We're like, if we need a third-party management outside this technology platform that we were literally playing with and trying to figure it out, we were looking at going with you and literally handing that site over for you guys to manage because you have such a good reputation. And you've seen a lot, obviously, since 2002. The last 3 years have been interesting. We'll put it that way for, I think commercial real estate in general. How has that gone for you guys in your portfolio? Like, how's the last 3 years? Did acquisitions slow down? You have a extremely large portfolio. You have institutionalized experience. You're doing syndicating. You're geographically in how many states now?
I think we're like in seven or eight states.
Yep.
All in the West.
So what are you seeing today, and what has changed over the last 3 years for your company, as far as actually like growing, like assets, like buying, but also just operationally?
Yeah. So on the acquisition front, it's been a lot of more creative deals with whether it's seller carryback, seller financing, or just all cash purchases, because debt's just more expensive. We saw a big run up in interest rates, as everybody knows. But also, I think the gap between, I don't think cap rates have followed. The gap between the cap rate and the interest rate has widened over the last few years, and so it's basically made putting debt on a property less attractive. And so some of our deals we purchased all cash, knowing that we would eventually put debt on and return some of that capital to our equity investors, but thought we would hold out and hope for maybe a slightly lower rate when we lock it in. So others, we did one deal that was like basically like a master lease where the seller wanted to sell, but realized if they did a seller carry to get the value they wanted, because they wanted a certain value, it didn't make sense with traditional financing. And so in order to get the value they wanted, they were offering a seller carry. But then they realized, maybe, I'm not sure, maybe they're not experienced real estate guys or whatever, but they realized that if they did a seller carry, they weren't going to get all their money up front, because some of it was going to be right. The loan, right? And that they weren't going and that they were going to exchange into a new property, they wouldn't have all the proceeds from the sale to then go use to buy the new property, and didn't have a bunch of dry powder with which to replace the money that they would ostensibly be lending to us in the seller carry. So we ended up doing a master lease to put off the start date of their exchange, basically. So we're operating the property. We are basically paying what they would have paid in debt service, so they can cover their own loan. And we have the option, in a sense, an option to purchase the property at some point in the future. So those are kind of the creative deals that I think we've been maybe slightly pushed into, Yeah. I mean, I'd been happy to do a traditional straight up deal, but I guess that's the other nice thing about when I mentioned jokingly earlier about being on to smaller and better things, like, back in our days of institutional capital, that might have been a more difficult deal to put together, so, to get that kind of approved, if you will. So anyway, that's those are the kind of deals we're doing. So we're in contract right now on a deal, actually 2 properties. They're right next door to each other. And but this one's a little different also. It's an exchange. So one of our investors has a big exchange. And so the yields don't have to be quite as good to make it worth pulling the trigger because of the exchange. So that's I'd say definitely slowed down in the last few years, transaction volume for sure.
For us, what you're saying is the exact same thing. More creative, right? We've seen a pickup at the start of this year where it feels like some seller fatigue has set in. And so they're more willing to come to a little more reasonable prices, but that isn't widespread. That's what we're feeling like within individual negotiations. And by more, I mean, we're talk to 100 people. It's still very limited, but we're actually seeing some move across the line. Have you seen any change?
I feel like the change I feel like there's still a ton of capital on the sideline. I haven't seen so far anyway, a big shift in seller sentiment and willingness to accept, significantly higher cap rates on sale. I mean, but I do see from an operations standpoint, some tailwinds forming that,
really?
yeah, I mean, just some of the stuff that was, I think supply is definitely slowed down, right? Because interest rates and cost of construction hasn't really changed, but interest rates have gone up. So new deliveries are slowing. And stuff like we have in one of the markets we're in is in Vancouver, Washington, for example. We had a new build there that opened just after COVID. There was a lot of other supply came online, so that was a little bit more challenging because we're competing with a lot of new supply. But now everybody else is starting to fill up. We're filling up, so our revenue per foot is definitely increasing. So from a valuation perspective, when I put myself on the side of an owner or a potential seller someday, like I can see myself feeling a little bit more comfortable selling because I feel like my revenue per square foot's going up, and I feel like I'm not leaving a crap ton of value on the table if I go to sell in the next 6 months or a year.
Well, we've seen the same thing. We saw that last year. We felt that, especially last fall, we didn't see nearly as much of a trough.
Yeah, no busy season, man.
Yeah.
It was just very flat. And I mean, we're sitting there, we were doing all the different things, trying to drive all our marketing efforts. And, those times are good because you really start getting granular and looking at trying to find all the gaps and pieces to really refine all your processes and what you're doing and where those expenses are and what you're investing in, which is great. But at the same time, not super fun to go through a lot of times. But yeah, because at that same time, I mean, we were also doing that. It felt like the race to the bottom thing. And you guys probably experienced that in some of the markets you were in, but the street rate situation was bonkers.
Yeah.
Yeah. I mean, we had one market in particular, it was just cratered. 60, you're talking 10 by 10s went from $200 to $60 in a month, and broad base everybody, it wasn't all our locations. All our locations we had over the last 3 years, we had contraction, but we had a few select ones that really dropped. And a lot of that was due to that new supply, which we've seen this year that we feel like has phased out, and we've actually been lifting rates and been moving into that new normal, which is awesome to see. But during that time, depending on which market it was, we had some that dramatically shifted.
Yeah, I agree. But I also think that with all the rates bottoming out and so forth, I mean, a lot of that, there's been a lot of discussion around that in the industry for sure about different approaches to revenue management and so forth. And that's driven a lot of that, people have occupancy to fill. And especially if you're a sophisticated, bigger player and have some data to drive some decisions, then you start to realize that your best bet's actually to fill them up and raise them later.
Have you guys started to do that as well? I mean, we did. So because in some of those locations, it literally was, I felt bad because I when it first started, like 3 years ago, whatnot, it was a few players that drove it, right? There was a few individual companies that really drove it. We're trying to fill those facilities up. And I thought, I'm not going to play this game. I'm not going to go cut rates, lift it up. Well, the market didn't care what I wanted. Weird. So that's, weird how that works. But so then we actually had to go in and really start more playing that game. Is that something you've had to see in some of your locations where you're like, hey, if we're not adapting this, we're not making it?
Yeah, definitely. You got to, I mean, the two sides of revenue management, right, are what your asking rates are and then what kind of in-place customer rate changes you might make. And from an asking rate perspective, you can't be completely out of line with the market. I mean, there's no website that's awesome enough to communicate to someone the difference between property A and property B when the price discrepancy is really big, right? Especially when you're looking at people looking on their little 3-inch pictures on their phone, right? I mean, there's just no way you're going to communicate that my property is that much superior to the guy down the street, even if it is better. It might be better. It might be way better.
Yeah.
But to get the average consumer to understand that it's better enough to be willing to pay, $50, $60, $70 more or whatever a month, if the market shifts, you're kind of forced to follow. And it doesn't mean you have to be the bottom of the market, but you can't be completely uncompetitive.
And you can't convince them that, try to explain the difference between a street rate and an in-place rate. I mean, try to explain that to a bank, and the underwriters of the bank, they don't fully understand it because it's so weird, especially in real estate. But to try to explain to a customer, which I did, I actually went on site with customers and they came in. I'm like, all right, I understand that they're offering you $20, but they're going to move your rate to $200 in 3 months. And it was kind of like, I don't care. like it's the difference between $50 to $200 or $60. It doesn't matter. So, because first of all, I don't think anybody thinks they're going to stay in longer than that. But then two, that's today. I get the discount today. So it kind of leaves you in a spot where, we didn't really want to play that game to that level, obviously, where it was like, I felt like, man, we're doing this, but then you're giving these huge rate increases, and we felt bad about how we laid that out with our customers. And so we'd explain to them and try to go, this is a promotional rate.
Exactly.
This is not your real rate. But the customers don't think like that. Like you said, they're on a screen and it's just click.
Oh, it's $50. Like,
it.
cool.
Exactly.
Then it's
and even if you try to explain it in some sort of text or whatever, it's tough to get that through. So
it is.
But I mean, one thing I thought was interesting, I saw at the last ISS show in Vegas a month ago, there was an exhibitor there who's doing kind of like white label storage, like repurposing small unused spaces and whatnot. It's called Stuff, STUF. I went on their website and kind of checked out like what are they doing for conversion rate. I'm always trying to get ideas around what people do to convert online. And one of the things they had was a kind of like an add-on where you could lock your rate for a year for an extra $10 a month. And I thought that might make sense in some cases, to give people an option to kind of pay me now or pay me later. I don't know. We haven't experimented with that yet, but definitely it's been a topic of conversation to kind of run you almost need to kind of look at it a little bit like an insurance underwriter and would I rather, is it better for me to get this money up front now or is it better to do rate increases later, and how much does that upcharge need to be to make it worth it to lock in their rate and so forth. But
and then you just add it in like the buy process, like they click to purchase and then it's like, would you like to insure that rate pops up, just add here. Well, it wasn't. Yeah, it was billed. If you want to check it out later, but it was billed more like almost like a premium, like kind of like you see value-based pricing, good, better, best kind of thing, right? Like if you see those guys doing that kind of thing, it was kind of like that. Where if somebody's trying to justify a better or a best price on their value-based pricing, they're always trying to throw in some reason why. The extra cost is you get a special priority phone number, you get a better location for your unit, you get whatever, and however they want to try to spell that out to try to justify the better or the best price. And in this case, it was kind of similar. It was like you get, a few different kind of perks. In addition to, and one of those perks was the lock-in. So it wasn't selling strictly just the price, kind of the price lock, but that was one of the perks, and for which, you could pay a little extra rent. And, again, I don't have any data on how many people take that offer, but I thought it was an interesting approach, something to consider. And I think we're going to see more of this as well. I think we've moved to the moment you move to that street rate becoming that promotional rate, that changes the mindset in revenue management add-ons. It changes just how you think about that rate, that value, and that management of that rate. So how you extract that value leaves from being the rent to being something else, right? So now you're plotting out how many rate increases, what's the average length of stay, right? What is the risk of a person leaving within a certain amount of time? It changes the math on how you get to a total value of that individual tenant and customer. And that's so unique in the real estate world, right? I mean, you have like motels or hotels that are doing, okay, we're changing dynamically the pricing, but there's no follow-up. It's not like that one night you can go, oh, well, I'll raise in 2 weeks, and everything else is really long-term contracts.
Yeah, I mean, I think for us, an area of opportunity for the average owner is really segmenting their customer base better, their in-place customers, because the regime of rate increases, so my perfect acquisition would be some self-managed property by a guy who has one, maybe 2 locations and thinks everything's amazing, has seen his equity in his property grow over time because storage has been a good business for many decades, right? But hasn't really thought really carefully. If he's doing rent increases at all, he's been doing them on a very just almost like the calendar dictates the rent increase. Like we're going to, every 6 months, every 9 months, every once a year, whatever their regime is. The calendar dictates the rent increase. And then there's probably no formula. I mean, we're just going to choose an arbitrary number or an arbitrary percentage. And then we're going to apply that arbitrary rent increase, often percentage, to the people that are now due, quote unquote, based on the calendar, right? I think where you see the more sophisticated operators moving towards, and definitely where we're moving towards, is to understand better and segmenting our customer base and not applying the same rate increase strategies to everyone, right? We're applying different rate increase regimes or strategies to different segments, right? Because some segments are much more likely to stay, some segments are more likely to go. And there's some clues about price sensitivity that you can glean based on, kind of the way you operate your business. And if you want to, and interesting for your listeners, if they go rent a unit from Extra Space, for example, you'll notice, even if you don't finish the rental process completely, you'll notice that they will ask you some questions about whether you're a student, how long do you plan to stay, some other things that they can then feed into their system. On one hand, as a consumer, I'm not sure what you're thinking if you're outside the industry, if you're just the average Joe consumer, what you're thinking about these questions. Maybe you just, some of them you maybe skip, I don't know. But I think all those questions are tailored. And I don't know this. I've not confirmed this with anybody at Extra Space, but my educated guess is that those questions are tailored to give them information that they can then correlate with likelihood of move out, length of stay, and other metrics that can help them tailor their rent increase programs. And so I think those are things that can get very sophisticated, but I think even for the average guy could make some educated guesses, right? I mean, if you just look at your customer base and say, hey, this guy lives 100 miles away, right? What's the likelihood he's going to be my most price sensitive customer? Probably not price sensitive. He's probably going to take a reasonable rent increase and not move, because who wants to, on top of all the other hassle of moving.
Or is it a business? Is that an LLC?
Sure. I mean, so you could get I think you can get quite sophisticated and even try to, like Extra Space is doing, try to increase the granularity of what you're doing. But even small guys can do it.
Yeah, no, whether it's on the front end or the back end, like getting that feedback and input from the customer is super, super important. So you can make, again, I love everything that you're talking about, because you're talking about making these data-driven decisions as opposed to doing that like, we're going to do a 3% rate increase every 6 months, or whatever it is, because even just the aspect of, or the act of mapping out your tenants and seeing where they're at, who they are, really understanding that. I mean, that's been a huge focus of ours.
Yeah, you're going to love a tool, Kenny, and we're going to have to show you that we're releasing next month.
It can just give you love it. Just so much insight in knowing where people are at, not only on rate management strategies and revenue management, but on, marketing delivery, on every aspect of how you're
that customer you want.
Exactly. How you're running the facility and operating things. It just gives so much insight in just mapping your customers.
I think a lot of people forget, if you have 200 or 600 units in a population of 10,000 people, you don't want all the customers. And the thing is, over an extended period of time, a lot of the people that are going to go to your site that want to buy is not your customer. And if you fill up the facility with the wrong customers, that has a huge effect, obviously, on the revenue. That could be everything from length of stay, price sensitivity, delinquencies, on and on and on. So, that understanding who your demographic is and that customer is, why, not just who, not just like a guess, but why that customer is yours. That changes not only revenue management, but like Connor's saying, your marketing efforts, your targets. It aligns better the company and how we present ourselves, everything about it. It's back to this traditional business where it's like, who in the world are you selling to? And storage, they're like, everybody. And I'm like, no, you're not. Literally, you don't have thousands and thousands of units. We're in Mississippi right now, and we're turning this storage facility around. Now, lots of people are out trying to buy facilities, small ones that range everywhere from $300,000 to $4 or $5 million. Now, they're worried about getting the money or having the financing. This is why we team up with Live Oak Bank, because they get this. They understand storage. In fact, we have them help us underwrite deals for our students and others. because they are one of the best people in the industry when it comes to getting loans, especially small business loans. They can actually help the customers when they find the asset, understanding how much debt can I get? What's it going to look like? Not just because of the customer they're working with, but because of their knowledge base. That changes them from being a bank to being a real asset to the customer. We recommend Live Oak Bank to our students as well as others that are trying to get into the storage business. They have an in-depth knowledge of this asset class, so it's more than a bank. It's more than simply getting money. They're actually an asset and a partner to them, helping them go through all the things that they don't know and understand.
Yeah, I mean, especially in areas, I mean, I think most dramatically in areas that have some student population, right? I mean, if you fill up your facility with students, you're basically signing up to have a bunch of move-outs in a few months, you know?
Yep.
So not to say that that's necessarily bad, but like, do I really want to put the bulk of my effort in attracting that customer, or do I want to attract the guy who's a middle-aged family who just needs storage because their family's growing and they want to make some room, you know?
We're dealing with that right now. We're like, so we bought a location, student population, so we're changing the pricing to try to identify how we shift organically, naturally, right, to that different type of tenant. Not that we don't want the students necessarily, but if we do, how do we make sure that, because I guess to put it simply for anyone listening, if you give a student, let's say 2 months free rent, and that makes up 80% of your population, and they only stay for 3 months, you're tanked. Like you can't pay your bills. So all of a sudden then, if we got customers that are only staying for 3 months, you obviously can't give them the whole time for free. But then how do you do that in a pricing way to where you attract the customers and the ones that are only going to stay for that short period of time, that they just pay what is needed to pay bills and take care of things? And I think your example of the students is the perfect example of that, because we see it, our occupancy at that facility that we just purchased, especially historically, it goes from, 100% to 60% every single year in a 6-month period of time. It just goes up and down.
Right.
And that could really hurt you.
Yeah. I mean, so one other observation I've made over the years is that when you think about a new facility that's opened up, and this might be kind of similar for your student population one too, or you're kind of revamping. When you think about the people who stay a long time, some customers stay years and years, right? I mean, if you've acquired facilities that have been around a while, you've seen this, right?
Yeah.
But we've also built some facilities from ground up. So we've got some facilities we've owned that were brand new. We had 0 customers. And so one thing we've realized is that there's some percentage, and I don't know what it is, but some small percentage of people will use storage for a long time. And the longer you've been open, the more likely that you've attracted these customers and have them as part of your tenant base. Whereas a brand new build, or in your case where you're trying to transition from the student population to kind of a more traditional population, it's going to take some time. And I think that's one benefit of buying an existing mature facility compared to building a new one, and especially if the rate management, if the revenue management hasn't been done very well or very aggressively in the past on an acquisition, and it's been around a while, they probably have a lot of customers that have been there for a long time, or more so than a less mature or a less time in market facility, just because they just haven't had that chance to kind of let those people glom on, right? I mean, they just kind of right?
Can't buy time.
Yeah, exactly. So I would think in your facility that's got the student population, I mean, I don't have any magic bullets for you, but I would think about it in the sense of the way I'm pricing and the promotions I'm making, so as to try to attract the customers that I want, and also the places where I advertise and so forth, right?
And that's pretty easy to figure out. Like, you could literally just go to the college and ask student housing and ask around the city, because everybody knows, right? And so, a lot of that homework looking, it's easier when you have, like you mentioned, the difference of having a facility that you're filling up and you're experimenting with that population to see where true demand is versus what you want, as opposed to a facility that has already been in operations and you can literally look back and
you've got the information to work from.
Yeah. Very different. What are the markets? So we talk about this, your students is a perfect example of a market that has very specific things that are driving, obviously, that demand. What markets do you guys look for? What is a market that this is the market we want, And what are markets that you guys say, hey, we're avoiding these markets?
So when you think of market, I think of it in a couple different ways. One is kind of the type of person that I'm trying to attract into my facility. And then secondly, the competitors with whom I'm competing, right? So we have purchased a lot of our facilities in kind of secondary and tertiary markets simply because I feel like we are pretty good at what we do, but so is Extra Space and Public Storage and CubeSmart and so forth, right? And so if I can compete with less of those guys and more of the standard mom and pop guys, the easier it is to win, right? It's just easier to win.
Yeah.
So that's one way when we're considering acquisitions, for example, or where to build. That's one thing we definitely take into consideration. When it comes to the type of person we're trying to attract into our facility, when you're brand new, it's a new build, like it's kind of beggars can't be choosers kind of thing. It's like whoever's going to give me money, right? Because I have so many vacant spaces that, like, if some of you are tenants or students and some of you aren't and whatever, like, you know, it's not like I'm going to run out of room to rent to the more ideal customer, right? The idea of like getting the ideal customer kind of only matters if you're down to the last few units and I'm going to run out this month. I'm going to, you know, and not necessarily units for your whole facility, but maybe, and if you think about it more carefully from like unit size, like small, medium, large, whatever, right? So that's really when it kind of matters the most. And when you're trying to get those last, it's like, hey, if I rent to you, that means I'm not going to rent to this other guy.
Yes.
But if you have plenty to rent, then just rent to everybody, right?
Everybody.
Like, that's what I think.
Yeah.
So when you're leasing up, I think you're just looking at who's going to give me money and how do I get in front of those people, you know, who has a need for storage and how to get in front of them. And then as you're getting more careful about trying to fill your facility with people who are going to stay longer, have more ability to pay, I would definitely look at just simple demographics, like who has money to, you know, where are the middle-aged families that have some disposable income and have some need for storage over a longer period of time, right? They're going to make a lifestyle choice rather than solve a problem for 3 months, like a student choice, right? That's kind of where I would start to try to focus my marketing and my exposure. If I'm going to sponsor Little League or whatever, like, you know what I mean? Like whatever I'm going to do that's outside of Google. I mean, Google's, you know, for sure the probably the most straightforward and simple way, but anything outside of Google, I would definitely be targeting towards those kind of the demographics that have more money and tend to be more middle-aged.
What are you guys, from kind of going back to, I know you'd asked a little bit on the operations, kind of what you guys are seeing differently, you know, as we're moving into this new world of self-storage. What are you guys seeing? What are you guys doing different than you did 5 years ago? And what are you guys planning? You know, how does the future look in storage from an operations standpoint?
I mean, nothing's like super, I mean, I'm not going to tell you any secrets that you don't know or your listeners couldn't figure out from other sources or anything. I don't have anything that special, I don't think. But, you know, things that we are doing differently now, definitely a lot more automation for not just for cost savings per se, like staff reduction, although that's part of it, but also just for customer service. So like I want my customers to be able to rent online and move in, whether that's during office hours or after office hours. You know, if the gate will open for them, because I want them to be able to move into their unit. So using things like DaVinci locks or other automated locking processes where I can let my customer, they don't have to stop at the office to get a gate code. They don't have to stop at the office to get the lock on their unit removed. Like just letting them do all that, right? That's, I'm not sure, 5 years, definitely in the last 5 years, but maybe earlier than that. I don't know, but that's something we're always looking at. Like, how do we make that easier and easier for people to do business with us, right? And some of those automation things help. Clearly, any kind of automation helps with consistency, right? Like from a standpoint of like rent collections or anything else. Like if the machine's going to do it, I don't have to follow up with a human being and try to cajole them or remind them or whatever, because the machine never forgets. Right. So any kind of automated follow-up, any kind of automated marketing that can happen to my customer base, we're all about that. Other things I think we touched on briefly, this idea of segmenting our customers and from a revenue management perspective is something we're doing. We're putting a lot more, I guess, emphasis on and trying to get more and more. Like it's kind of a law of diminishing returns, right? Like the low-hanging fruit. If you've been doing this a while, like the easiest money you've already figured that out. So now you're trying to squeeze out the incremental 1 or 2%, right? And so getting more sophisticated in revenue management, I think it's much bigger than 1 or 2% opportunity. I think it's a pretty big opportunity. It's kind of hard to get to from an effort and cost perspective. So it's sometimes out of the reach of a smaller operator. I don't know. Those are some things I think that come to mind when I think about what we're doing differently now. One thing that's a couple pain points, man, maybe you guys have some ideas on this, a few pain points that I think integrating with software on the checkout of your website and the APIs and all that stuff, still a pain point in the industry. I feel like going to my software or my web developer and saying, I want to do this in the checkout funnel because I think that'll improve conversions, and having them tell me, well, the API doesn't really support that very well. Like that's, whatever, right? Oh gosh, that's so much brain damage.
Yes, that is an ongoing problem, I think, with everybody. The ability to make changes fast, fluid, and customize them in a world that is tethered together by limited APIs, but yet all the functionality is siloed out is a ongoing issue, I think, for everyone.
Yeah, and I feel like also, especially if you have a little bit of scale like us, we're not big, but we're, for us to change facility management software is a huge undertaking. You know? And, kind of talking to my team, there's the whole Jeff Bezos, one-way door and two-way door. You've heard of this, where he talks about if it's a two-way door, it's easy to reverse your decision. So make those decisions quickly, right? Don't get bogged down in a heavyweight decision-making process if you can just change course. Right?
Yeah.
If it's easy to reverse your decision. But changing out your facility management software feels a bit more like a one-way door. Like if you do this, it's going to be very painful to unwind. And so we're in the process of evaluating alternatives, but we're being very kind of slow and methodical about it because, to convert a bunch of stores over to a different software provider is a huge undertaking.
It's a huge undertaking, and you have that aspect of there's no guaranteed outcome or return on that effort. You're going to go and you think it might work and you have good, idea of how things might operate or work, but until you're actually there and you're doing it, it could end up costing more than it's actually worth. So no, it's good to be slow and methodical for those things. I would agree. It's a one-way door kind of thing.
Yeah. I was just looking up because I was along this line of, this one door, two door. We've been, and I focused a lot in the past of this idea of impact decisions. And I think that this is a huge problem for self-storage owners and operators alike, is the decision-making tree in an organization is not qualified very much on impact on the organization as a whole. As in, where does this all go? So the idea of whether I'm doing these software, there is no point in which that property management system does not impact. So it's not just like you're changing the software system, you're disrupting your acquisitions. You're now taking everyone's times. You're accounting. I mean, it is so tethered into everything. Yeah. And that's also the importance of adaptability, though. So like when we look at those one door, two door decisions, when it's a one door decision, I'm very concerned on how adaptable that decision will be in the future. So is that a door that opens up, or is that a door that goes into a very narrow aisle? And I now am accepting this very narrow aisle for what it is 2 years down the road, because that doesn't allow for the industry to evolve and change. And I can't control those things. I can't control if my customers adapt to something else. I can't control what will happen in that decision-making process, whether that's from iPhones, whether that's any of those things. I have no control over that. So it's really important for me that I feel like we're focusing heavily on those, but also that we're going down a path that we can adapt as a company to whatever changes the marketplace gives us. And that's been a sticking point, I feel, with self-storage, because in the past it's been, we're not adapting to our customer. They need to adapt to us. Like, this is just the way we've already done it. A website, why do I need a website? People just drive by. We've been an industry that has been slow to adapt, but I feel like in the last 5 years, everything's about adapting now. And so that's like storming in, and a lot of solutions are being thrown, and that's making people make a lot of knee-jerk decisions. So I love this idea of the one door, two door. How do we quantify this decision, right? And how does it work within the whole?
Yeah.
Because that's a big change that happened though when we went to not only online, but you have your property management system, your online basis, all customers, this automation, it's centralized everything. So everything is really, really connected. You take managers out of the store, right? All of a sudden, that central part is one problem within it gets reverberated and just cascades to every single store. And we saw this. We saw this in our own and how it really, really impact. Are you guys moving towards more of this automated, centralized management style? Is that something that's coming out of necessity where we're like, we need to pull managers back? We're not doing bigger stores. We're going with smaller stores. How do you guys view that operational part in your acquisitions now, moving forward, controlling expenses?
From an acquisition standpoint, we're tending to still buy larger locations, like 50,000 net rentable and bigger. And 50,000 it's harder to justify even if you're in a market that doesn't have higher rent per foot, right? So that's where we tend to buy. We have added some smaller locations when we can operate them kind of like hub and spoke. And that's just, that's just our preference. I'm not saying this is the right way to do it or everybody should do it this way, but for the few locations that we operate unmanned, we like to have other facilities close by with staff that can go deal with whatever might come up rather than have a contractor or a handyman or somebody that I got to call in that market to go deal with it. I like having my own people. It just makes it easier for us operationally. But again, I'm not saying that's right or wrong. It's just how we've done it. But there are certain things for sure that we've more centralized over time. And like, for example, call handling phone calls and adding automation to those. Like if you want to call and pay your rent, I want to give you an automated way to do that rather than having to take my staff time to do that. But also just from a standpoint of conversion rate, right? Like I want, when somebody's calling in, as we got bigger in kind of version 1.0, I guess, of our portfolio growth, at first, we were trying to train all our managers to be excellent on the phone and convert people from inquiry to rental, right? But after you get a handful of people, you realize they can't give enough feedback to your people to make them good at this. And you're expecting your store manager to do all kinds of stuff, right? You're expecting them to be a handyman. You're expecting to be a janitor. You're expecting to be a customer service rep.
Preaching to the choir, man.
Right? Right. So, so getting them to be excellent salespeople is difficult. And also, if you feel like if a store is doing, let's say it's a fairly high volume store. Let's say it's doing 60 rentals in a month, and you're open every day of the month. Let's say you're open all 7 days, all the time. So you're doing 2 rentals a day on average, and let's say you're converting, let's say 50%. So you're getting 4 chances to rent. Maybe 4 chances to rent, and you're renting to 2 of those 4 every day, right? I mean, who's getting good at shooting free throws, shooting 4 free throws a day? No one, right? No one gets good at anything doing it only 4 times a day, or even if you doubled that 8 times a day, right?
That's a
so
good point.
Putting all of our inbound calls to a select group we basically have like an internal call center, right? So we have a handful of people that are good at sales, and we push all of our inbound leads to those people because then they can get 30, 50 free throws a day. In addition to any kind of customer service stuff that they end up handling. I mean, we try to filter it so that they're dealing only with sales calls. It doesn't work perfectly. So they end up dealing with some customer service, but they get way more sales chances than any store manager ever did. And so they get way better at it so that their conversion rates can go up.
Yeah, it's their one thing that they can be an expert at, right?
Yes.
Like they can really dive in. And that was one thing that we really realized as we were scaling too, is like, we've got to get rid of the guy wearing all the different hats and the Swiss Army knives and all this stuff as personnel, and really bring in the subject matter experts for that one specific thing. And that's all they do. Like you said, I mean, there's going to be little things here and there that, they're going to bleed into that role, but really, really important as we scaled. And that was one of the things too, I wanted to make sure we'd asked you too on the podcast is like, as you guys scaled from an organizational standpoint, what were some of the big aha moments from like a structural aspect? And then also what has allowed you guys to attract and retain amazing talent?
Okay, so from a structural thing, let's address that first. I mean, I know you guys are familiar. I don't know if you use it, but I think you're familiar with EOS.
Yes, we use it.
Yeah, you use it. Okay, so yeah, I mean I think the accountability chart piece was a game changer for us to kind of look at not so much as an org chart as like who does what, but looking at it from the standpoint of, okay, here's our goal for a year, 3 years, 8 years out or whatever. What does this organization need to look like? What are the people? What are the seats? What are the slots that we need in order when we get to this bigger scale, when we're at this larger spot, we have more stores and so forth. Like, what seats do we need, and who we're going to fill into those seats? Is that an outside hire? Is that a promote from within? Are we grooming somebody now for that role? Like, that was using the org chart as a planning tool and not just an information center.
Not a here's the numbers or how to get a hold of it.
Yeah,
like
right.
A contact list.
Yeah,
right.
exactly. Not a contact list that happens to be structured in a pyramid, right? Right. But using it like a planning tool for how do we, who do we need to achieve our goals, and how are we going to do it? That added some great structure for us, and also the common language of EOS, having the common vocabulary inside of our organization was really helpful as well. So I'm a fan of EOS. So if your listeners are growing and want something to help them, and they don't have to reinvent the wheel, I think EOS is a great tool.
So I was looking up stuff as you were talking, because what we're talking about here is so important, and how, especially people doing the one thing, how that changed the way we concentrated our sales part and how we leverage the outcome. And you mentioned this about this common language. And I think this is really important, because I have this viewpoint where I'm like, if you really want to be successful, it's kind of like, I guess, weird or contrarian in thinking, but if you want to be really successful, you need to be completely inconsistent, and you need to be like almost bipolar in the short term with the small things, but then with the big things and the important things, you need to be immovable. So I think like it comes back to that one door, two door kind of thing, right? But when you look at our goals, when you look at that common language, how we speak, no, this is how it's done. We know what we're going towards. We know what our core ethos is, who we are. We stick to these things. We do it. In the short term, we experiment and we care about outcomes only. So I'm like, I don't care what we necessarily think as in what works. We need to A, B, C test this and see, because the process of getting to where you're going is not solely contingent on you. It is contingent on what you have, what's in front of you. And for people to say, I don't care, I want to get to that location, so I'm going to walk through these whitewater rapids because this is how it should be done.
I was going to say,
it doesn't make any sense.
And you can't make the decisions, and you can't see until you're there, right?
Yes.
Like you're taking the steps kind of into the abyss, if you will. And again, you might have a good idea of where things are going to go, how it's going to play out. But yeah, as far as what those pieces look like as you're growing and building and figuring it out, I mean, you haven't been there before.
You haven't been there.
You haven't opened the door yet. Yeah.
And so it's like focusing on who you need. You're talking about the right people in the right seats. That long term, we know who we are. We know what we're doing. And then creating a structure. And that's what EOS provides, right? That structure around it. Those are foundational things.
Yeah.
And you want people to be able to change, experiment, and do a lot. But you can't do that when you don't have a structure. You don't have a common language. You don't have things that are immovable, that people can get a hold of and allow them to, because then everything just becomes, chaos. But I think people go the other way, and this is how we do it.
One thing becomes more difficult as you get bigger, but I think is always brings insight, is this idea of go and see the work. Go spend time in the store, go spend time sitting with your call center reps, go and see the work firsthand, which becomes more difficult as you get bigger, right? Because there's more work to see. It's more spread out. It's just more, you got other things you got to work on. Like, I got people that do that. Like in my organization, I've got district managers, I've got call center manager, I've got operations man, whatever, right? Like there's people who are part of our team who have that responsibility, right? But I think to go for that person and for you as the head honcho or whatever, like to go and see some of the work, I think will give you insights. And if you're not embarrassed by what you see, you're just not looking hard enough.
Exactly.
Right? because you're going to notice stuff that's like, because you mentioned about some things being like immovable, the way we do things, right? But sometimes the way we do things is an amalgamation of stupid theories that just got like put together over time.
Right.
And it's like, it's not well thought through. It's just like, that's just like the way it was done. And the next guy inherited that, and the next guy inherited that, right? Like Dan Heath in his book Reset tells a story about a company that turned off their printing press every day at 11:30, and the reason they turned it off every day at 11:30 was because years ago the power company was sending them like not reliable voltage during the lunch hour or whatever, and so it was damaging the equipment. And so they realized, oh, okay, to avoid damaging our big equipment, we need to shut it down during this period of unreliable power. Well, the electric company sorts their problem out of their electric generation out after some period of time, but they never get some sort of formal notice that this has been sorted out. So for years, this it's almost becomes like the sacred cow of like, here's how we do it, but it's based on some faulty thing that made sense years ago but doesn't make sense anymore, right?
And that's the thing that people have a hard time with, like this idea of being firm in your beliefs and your knowledge stuff, but then being able to adjust against different conditions. This is the definer to me of success. It is somebody that's adaptable, because like you can be successful at doing something because you're really good at it, but that is predicated on conditions not changing. When you're scaling a company, you don't have that luxury because change is the only thing you know. Problems is the only thing that you should see. Because like you said, I love that, because you're just not looking if you don't see them. Yeah. That's always terrifying to me. No, we're doing great. We haven't any issues. I'm like, then you're training yourself to not see the issues. Like that's really a bad thing, right? Mm-hmm. And this idea of as you're growing, change is inevitable. Problems are the way. They are the actual path, and that you need to be programmed to see them, not out of a negativity spot, but as a curiosity, solution-driven progress thing. And then also, though, be immovable in the direction that you're going, right? And why you're getting there. And this adaptability is so important today, because so much is changing, and it can make people just freeze because they don't have a foundation that is strong enough and they're not adaptable. I think if there's ever a guiding rule, successful people are adaptable. They just are. They can change because we don't have control of those conditions. That defines storage in the last 6 years. I mean, go back to 2018 and look at how storage facilities, for the vast majority of the industry, 80% were even being ran.
Dude, we didn't even have REITs in Boise.
Yeah.
Then.
That's wild to think about.
That amount of changes happened in that short amount of time. I was thinking about this the other day. I was just like, holy crap. Because I was looking at competition and how the industry has just changed from a competitive standpoint in a lot of these markets that we're in. And I was like, it used to be, follow up with your lead in, 24 hours or a day or whatever. But it's like, no, it has to be like 5 minutes.
Yeah,
it has to be like immediately. Where back in the day, that was kind of the standard for managers. 2018 and those time frames before.
Get a hold of them the next day, move them in, and that actually worked.
Yeah, and it was like gravy, right? We're 85% occupied in every facility and doing great, and things are amazing. And you just can't do that now. And that's another thing too that I really try to stress to a lot of these folks that are just starting to get in, through our self-storage income community. And some of this is where it's like, this is work, guys. Like it is not this just, oh, I'm going to go and get this passive thing for me and my family and it's amazing and all this stuff. Like, no, it's a lot of freaking work, man. And you better be ready to compete. You better be ready to adapt, to have constant change, because it is running a business. It's not, and I think anything that you do is going to be that. This idea of anything passive just doesn't exist.
Yeah,
it's a magical unicorn thing.
Investor just giving somebody your money, but if you're doing it yourself, it's not. So when you look at somebody starting out, we've talked a lot about the manager, like that stuff. Let's talk about getting started. I'm going to take away everything from you, Kenny. The only thing that you have left is the love of your family and your brain. Other than that, you lost your house, everything. You have no pennies. You have no connections in the industry. How did you get started today? By the way, you're working a full-time job.
But do I know what I'm do I know, like, for example, I feel like
You know storage.
So I know
all
storage.
of your knowledge. Yes, you know your storage. So
okay.
you're working a full-time job and you want to break into the industry. You have the information that you know today. You just don't have resources. You don't have connections, anything else. How do you go and get started? What do you do?
Well, if I know what I know now, I feel like I could really add value to people, right? Like, even if I don't have my own business, but I could find somebody that's running storage or whatever, and could help them. So, I mean, that's how I started. Basically, I mean, I didn't know really anything about storage, but I mean, I had some basic business acumen, right? And I had hard work. And so I went to work for somebody else that was doing storage, and at the time, storage and mobile home parks, and, cut my teeth as an analyst, right? So that would be one path, would be go work in the industry for someone else. I remember my guys, Tim and Greg, my two partners, interviewed me this is back in 2002, I think, and asked me what I want in my career. And I was like, well, I'm just gonna be honest, guys. Like, I don't intend to work for somebody my whole life. Like, I think what's going to happen is either I'm going to become a partner with you guys, or I'm going to start my own thing after some period of time. Like, that's what's going to happen, and thankfully we still work together all these years later. But that would be one. But if I knew what I know now, because I'm now a 20-year veteran, I suppose, of the storage industry, 20-plus-year veteran, I would just go find some properties that needed help and be like, I'm going to help you make money, and then we're going to work out some sort of compensation that's like going to reward me, and then eventually, hopefully just keep like you said, it's work. Like, just keep networking, keep working, keep meeting people. Opportunities are attached to people, and so go to conferences, maybe even go in my little neighborhood. Like, I live in Coeur d'Alene, right? So maybe I go to all the storage facilities between here and Hayden and Post Falls, and just start meeting everyone and just talk to everybody and be like, hey, let me try to help you. Like, I mean, I find we still find it, facilities, for example, that don't sell like any kind of tenant insurance or protection plan, right? Like, okay, how about I help you make an extra $50,000 this year? I can do that.
And that's why this right here, everybody, this is why Kenny's successful. This is why everyone should just bottle up what he just said. The whole entire time, the only thing you talked about was value. How can I give others value? What can I do? Even when I didn't know a lot, I knew a little bit of these things. I know tenant insurance. I can go talk to the sole focus on you going out and providing value. When I hear people that can't seem to move in life, and like when we're talking about storage, the number one thing that I hear is, I haven't gotten any opportunities. And I'm like, well, of course, because why should you? Why should you get any opportunity? Like, I don't get that. Like, you're not necessarily special, right? Like, why? Why should you get it? It's about providing it. And that, like, everything you just said as you walked through. How do I provide value? How do I give something to them? And then in return, and not just compensation, but I can learn. So it's, how can I deliver value, and how can I create more value within me? And that mentality, that is, first of all, obviously an entrepreneurship mentality, but that is the best answer I think I've heard from anyone on the podcast when I ask that question.
It's the name of the game, man, providing that value. And the other thing is that connections, like you said, the opportunities come from people. That can't be.
So you create the conditions when you get the opportunities.
Yep.
Not just somebody hands it to you. You go out and you make those conditions so you can get the opportunities.
Yeah, I've got a pet peeve with the whole self-made badge that people give you. I'm like, dude, no one self-made ever.
It doesn't exist.
I know people don't necessarily mean that they never had help from anybody when they say those things. They just generally mean, it kind of came from nothing.
But that mindset is like a cancer to me, because you only make it by helping others.
Yep.
You only make it by creating value within yourself and providing that. And then when other people get lifted up, that's how you get lifted up. I think that was amazing.
Yep.
Great answer. Kenny, I know you're supposed to be out on the lake. We've kept you over an hour.
Dude, we got to get you there.
So, hey, thank you so much for coming on. But here, real quick, where can people go find out about your company, learn about you, get into contact with you? Where can we put down here in the show notes, everything else for people to reach out?
Sure. You can find out about us at propertymanagement.storage or pm.storage. Both go to the same place. Our investment company, we've been doing this a long time. We actually don't even have a website for our investment company because all of our investors, they just keep coming back. So I couldn't point you there. If you want to connect with me personally, you can find me on LinkedIn, /in/Kenny Pratt. And otherwise, I'm not really active on social media, really. Like back in the day when Twitter was new, I was just actually looking at my Twitter feed yesterday. I was like, wow, maybe I should just delete this. I'm not sure there's even any upside to having this anymore. And I'm not one to kind of post a bunch of stuff about my adventures or whatever, although I do like to have some adventures. I don't generally put it out there anywhere. So, those are ways I would love to get in connection. I mean, I think some things aside from just doing a deal together or helping you with your property management or something, other things that I'd be interested in talking about would be any kind of use of AI in storage. I think that's been a huge topic lately. How people are using those technology tools, what people are doing in revenue management and tools they're using there. I think we're kind of stuck to a smaller tool set in storage. It's a smaller industry. So, the amount of facility management softwares we have to choose from, the amount of off-the-shelf revenue management tools we have to choose from, start lending us to some, for me, I definitely get a sense of a lot of times wanting to build my own thing or build my own add-on or build my own extension because of the limitations to some of the stuff that's off the shelf. And so, but also at 40 stores, that's like not small, but that's like not huge either. So some of these things would be a heavier lift, and I'd love to partner up with other people, or at least talk about the ideas of partnering up with other people to build some of the cool tools that maybe we need.
And I've got some ideas for you. So yeah, okay. I'm excited to
yeah, no kidding.
Everybody go find Kenny online. Go check him out. Reach out to him. We really appreciate you coming on. Thanks for being here. I know it's a nice warm day finally, and so you want to be out on the lake with the kids. So have fun, and we appreciate it.
All right, thanks guys. See ya.